on February 1st, we'll probably see another 25 or 50 basis points, so we will be at 4.75 or 5%. Now, most of the Fed governors are saying roughly 5%, maybe a little bit more, and then we're done. Maybe the Fed will start talking a little bit more about some of the very significant declines in inflation and outright prices that we have begun to see. And again, we'll go into that in a moment. One other thing to note about monetary policy, it's very influenced these days by Keynesian economics and something called the Phillips curve. Phillips curve basically suggests that if employment is strong, then that will lead to inflation. The history of the last 40 years, however, is the opposite. Employment was pretty strong when you adjust out for recessions, pretty strong for the last 40 years, and yet inflation and interest rates came down quite a bit from mid-teens in the early 80s to 0.5% during COVID. So the history of the last 40 years does not support the Phillips curve, and yet it is interesting to listen to the Fed say, wow, employment, we got to get it down, otherwise wages are just going to take off and become embedded in the system. That was the 70s experience, but it has not been the experience since then, and we do not believe we're in anything like that environment, as I just mentioned. And now the reason it's wrong is when employment is increasing, employment and output are increasing. If they're increasing in a healthy way, then productivity is increasing as well. And we've had a lot of dislocations associated with supply chains recently, so it's very hard to tell where we're going to settle out in terms of productivity. But we do believe, if we're right on how much innovation is taking place, that productivity is going to start scaling in a surprising way and take the sting out of inflation fears completely. So just wanted to share that with you. Now on to economic indicators. I'll go quickly through this part. We did get the employment report today, and it had something for everyone. For those who think the economy is booming, the unemployment rate dropped from 3.7%, which was revised to 3.6, to 3.5, so back to the cycle lows. Non-farm payroll employment looked stronger than expected. I think 223,200 was expected, but previous months were revised down. So that was interesting. The other measure of employment that I've mentioned on this video a number of times is the household measure of employment. Now, it had been falling on balance since March of last year. And in December, there was a big burst, 781,000. Now, this incorporates more small businesses into the survey. So 1 month does not a trend make. It does not erase at all the gap between non-farm payroll employment and household employment that has built up since last March. There's a 2 million person gap. So the truth is probably somewhere in between. Average hourly earnings came in lower than expected, 0.3, expectation was 0.4, and more important was the previous month, which caused such consternation in the markets, was revised from 0.6 to 0.4, and then we had this drop off to 0.3. Now, part of this is a function of mix shifts. You're seeing a lot of high-profile layoffs in the technology industry. Those are high-paying jobs. You're seeing a lot of the employment growth that we're seeing right now in the leisure and hospitality sector. That's lower. Those are lower-paying jobs. So there is a little bit of mix shift at work here. On a year-over-year basis, the rate is now 4.6%. Last month, we thought it was 5.1. Turns out, I believe it was 4.8% after the revision. So again, at turning points in all kinds of cycles, whether it's activity or inflation, we get a lot of revisions. Most important to me in this report, besides the fact that there was that pop in household, so employment isn't falling off a cliff, but the work week did fall 0.3%. And that is going to have an impact on incomes. It looks like personal income or personal disposable income will be up only 0.1% month to month when you take all these factors into account. That's not very much. We had better hope that inflation continues to slow. Most of the inflation indicators we've gotten in the last 2 months have been better than expected. And the Fed's beginning to mention that, but isn't buying into it yet. So we're in a period, we think, where average hourly earnings on a year-over-year basis are still falling in the 2.5% to 3% range in real terms, taking account of inflation. We also got another number today, ISM for the service sector. It's an index that it's a diffusion index where anything below 50% suggests that the economy is contracting. And the most important number in that report was orders, always is. Orders dropped 10 percentage points, very sudden and very rare for this index. And as you know, services are a much bigger part of the economy than manufacturing. So that drop-off in orders is reminiscent of what we saw during 08-09, and not at all what we saw during the COVID crisis. So much worse than that. And I think we're probably in response to that going to see more layoffs in the service sector and probably some of these employment metrics turning a little bit more negative. The orders number corroborates what we saw from factory orders for the month of November. They were down 1.8%, and even more important, the previous month was revised down from plus 1% to plus 4%. So again, at turning points, we look at revisions, and while we think that when history is said and done, the recession started at toward the beginning of this past year, most statistics are still conflicting, and so that's why I'm saying at turning points. The other notable stats we got include the trade balance. Now, GDP has been stronger than expected. One of the major reasons for it is a collapse in imports relative to exports. So imports subtract from GDP. So if their imports dropped 8%, so if you subtract that, you're really adding to GDP. What is this saying? This is saying that we are cutting back on inventories. Much of them coming from China. I think in the import report, consumer was the biggest fall off, and that would be associated with China. Exports fell, but not as much as imports, and therefore the trade balance improved, and that's going to help economic activity. But it's not for a very good reason. If you think about this, exports down 8%. That's not year over year. That's month to month. You know, that's like 100% annualized percent decline, almost. Well, that's an exaggeration, but almost. So that's a very big drop and a big hit to China and other economies, I would suggest.